Good morning, everyone. Ladies and gentlemen, let me welcome you to the Czech National Bank's quarterly meeting with analysts, which is a bit special today. First, due to renovation works at the Czech National Bank's Congress Center, we are meeting in the room where reports and forecasts by the Monetary Department are presented and discussed by the board. But even more important and interesting is the fact that we are meeting only a day after the Czech National Bank's board decided to raise interest rates for the first time in almost a decade. I believe there is a lot to discuss, and it is my pleasure to introduce our speakers for today. Vice Governor Vladimír Tomšík, Monetary Department Executive Director Tomáš Holub, and last but not least, Mr. Tibor Hlédik, Head of the Macroeconomic Forecasting Division. And it is Mr. Hlédik who will present the Czech National Bank's new forecast today. So, Mr. Hlédik, the floor is yours.
Thank you. So, good morning, ladies and gentlemen. It's my pleasure to have the opportunity to welcome you here in Prague, and also those of you who are following us online. Let me start with the presentation of our new forecast, and here you will see the outline. First, I will talk about the external and internal assumptions of the forecast. Next, I will talk about our new macroeconomic projection, and I will shed light some of the details that are behind what is behind the new forecast. And finally, I will give you or point to the main factors that are explaining the shift in our forecast compared with our projection that we published in May. Okay, let me start with the external environment. The GDP growth in the euro area at the beginning of the year reached 1.9%, and practically all segments within domestic demand contributed positively. Only net exports were contributing negatively. The economic growth in the effective euro area will accelerate above 2% this year, and then gradually return to that level. In terms of prices in the producer prices in the effective euro area, we have seen a strong growth in PPI at the start of this year, and this growth will gradually slow down until the start of next year, and afterwards it will return slightly to 2%. The main reason behind the slowdown is that at the beginning, oil prices were contributing at the beginning of the year very strongly, and this oil price effect will gradually diminish from the year-over-year growth. In terms of monetary policy, the ECB will maintain accommodative monetary policy stance, and the ECB officials were communicating that they will maintain the quantitative easing strategy until the end of this year. According to the market outlook, the 3 months interbank market rates will not turn to positive until 2019. And finally, the euro-dollar exchange rate will be relatively stable on the forecast horizon, although in the second quarter we have seen depreciation of the dollar, which was partially due to the worsening growth prospects in the US, but at the same time the Eurozone was doing better than many analysts anticipated. Another important input into our forecast is the contribution of discretionary fiscal policy into the year-on-year GDP growth, which we call Fiscal Impulse. And here this table is showing what are the main contributions and main factors behind the Fiscal Impulse which is showing that the exponential effect of fiscal policy will be strongest this year, and this effect will gradually weaken in 2018, and it's going to be almost neutral in 2019. In this year, the positive fiscal policy contribution will be mainly given by the recovery and government investment growth after the slump what we have witnessed last year, and also private consumption will add to demand-led pressures, which will be driven mainly by the package of new social measures proposed by the government. In the coming years, still, especially in 2018, private consumption will add to demand-led pressures, as I mentioned, partially due to the new social measures, but also due to a strong growth in public sector wages. Okay, let me turn to the new forecast, and here I'm just providing the brief summary of our new projection. Headline inflation will stay in the upper half of the tolerance band this year and return to the 2% target at the start of the next year. Monetary policy relevant inflation will be very close to the headline inflation, and the main reason is that the first round effects of changes to indirect taxes will be negligible on the whole forecast horizon. The growth of the Czech economy will accelerate visibly above 3% this year and will stay slightly above that level in the following 2 years. If we look into the main factors that are explaining the robust economic growth, of course, there are robust growth in household consumption, continuous growth in foreign demand, and also, as I mentioned, the gradual renewal of government investment co-financed from European funds. We'll see an accelerated growth of wages, and besides the initial conditions when we have seen we were surprised with higher wage growth, what we were expecting. At the same time, we have got the short-term indicators, monthly figures are showing that wage growth will be also very strong in the second quarter, and of course on the forecast horizon, the higher economic growth will generate enough pressures, the wages to grow at higher rate than previously we saw. The koruna will appreciate further against the euro, and the main factors behind it, of course, the positive interest rate differential, the continuing quantitative easing by the European Central Bank, and also renewed real convergence, which will show up in the equilibrium real appreciation of the Czech crown. The monetary conditions will continue to shift towards the neutral stance, and consistent with the forecast is an increase in domestic market interest rates in the third quarter of 2017 and subsequently also in the following 2 years. So this is broadly the summary of the forecast, and let me turn now to the individual blocks. First, I would show you the what's going on in the inflation front. I start with the structure of inflation, where you can see that the recent numbers are showing that the main contributors to total inflation are core inflation and food price inflation. Within core inflation, you can see that the strong domestic pressures are showing up, especially in prices of non-tradable goods, where we have seen a further upswing in imputed rent, and at the same time we see the probably partially a one-time effect of launch of electronic sales registration, which was introduced in December last year, and probably part of this effect will just disappear from the year-on-year figures in December of this year. So we can see that the domestic inflationary pressures are growing, and especially it is visible in the non-tradable goods sector. And at the same time, we can see that there's a difference between a growing difference between tradables and non-tradable goods, which is just a support for the renewed real appreciation of the crown. In terms of headline inflation, the inflation pressures are currently peaking, reflecting the accelerating wage growth, and in the conditions of strong domestic economic growth. Headline inflation will decline at the start of the next year and will be slightly below the 2% target over the monetary policy horizon. And I will talk about the reasons and about the structure of total inflation. Monetary policy relevant inflation will differ only marginally from headline inflation. As I mentioned, the effect of indirect tax changes on headline inflation will be overall negligible. On the one hand, we see the increase in excise duty and on tobacco products, and these are broadly offset by VAT changes applied to restaurants and also newspapers and magazines. To go further into the price development details, administrative prices will not go up until 2018, and they will accelerate only slightly to 1.5% in 2019. The faster growth will be prevented by almost flat prices of energy commodities, and we'll also see a slightly appreciating krona-dollar exchange rate. And you can see that on the whole forecast horizon, practically we will be below the 2%. We will be below 2%, and that will generate a little bit downward pressure on inflation on the monetary policy horizon. According to the available indicators, fuel prices were lower in July than in the previous months, so we'll see a continuing deceleration in the year-on-year growth of fuel prices. On the forecast horizon, practically we are linking our forecast with world oil prices, and you will see that temporarily oil prices will fall this year and beginning of the next year, and then we'll gradually go back to some very slight positive growth rates. And now we are at the core of our inflation development, and this is core inflation and partially food price inflation. In the near term, core inflation will accelerate further as a result of currently strong cost pressures and then slow down to 2% owing to decline of import prices. As I mentioned earlier, the surge in core price inflation is mainly due to very high growth in the non-tradable goods sector, and this is just reflecting high pressures from the domestic economy. The food price story is slightly different in a sense that in the short run we will see a further acceleration in food prices. This is due to the growth of agricultural commodity prices on world markets, but you can see from the figure that in the short term we will exceed 4%, but then we'll go back to 2% on the forecast horizon, as world commodity prices will also gradually show lower growth rates. In terms of the costs explaining the overall inflation development, we currently identify peaking inflation pressures that will ease somewhat in this year, and this slowdown will be given mainly by anti-inflationary import prices, given that I've shown you that we revised foreign PPI growth rates quite substantially. The domestic costs will continue to rise, although at a slower pace that we can see at the present. You can see that will gradually grow down especially in domestic prices from the current levels. This will be given by slowing down in wage growth and also some upswing in labor efficiency, which will just mitigate the cost pressures in this segment. Let me turn now to the real economy. GDP growth will rise to 3.6% this year and fluctuate close to 3% in the following years. The growth in domestic GDP will be driven maybe by robust growth in household consumption. That will reflect the optimism of consumers in an environment of continued growth and very strong labor market performance. And at the same time, this environment will generate faster growth of wages, and of course, low interest rates will contribute to the overall good performance of the Czech economy. Let's look a little bit more detail into the individual expenditure components of national accounts. The strong household consumption growth will reflect a further rise in wages and salaries, but it's quite important to stress that also other income, because I mentioned that fiscal policy will contribute positively through social transfers. Also, the income of entrepreneurs will contribute to overall growth in household consumption. Growth in investment will reflect the recovery of renewed drawdown of EU funds, and also faster growth in private investment. The main driving forces behind this development are just the real rates, and also in private investment we see a high correlation with foreign demand. So these factors will help investment to recover from the negative from the fall in last year. In terms of exports, we witnessed a significant slowdown in exports in the second half of the last year, and partially this was due to some slowdown in exports in automobile industry and some energy related energy production. These effects will fade away from the year-on-year numbers, so this is partially behind the fast recovery of exports in this year. Then subsequently you will see a little bit of a slowdown in exports. This will be due only to exchange rate appreciation only partially, because the forecast takes into account that the exporters are mostly hedged against the exchange rate risk. And otherwise, besides these one-time effects, exports will broadly follow foreign demand. In terms of imports, we are here just using the import intensity of consumption. Of course, investment is recovering fast, therefore it will add to growth in imports, and also the exports growth are playing being import intensive important role in the shape of import growth. Let me turn now to the labor market, namely the employment. The growth of the number of employees converted into full-time equivalents will be pronounced throughout this year. And you can see from the figure that we count on gradually slowing growth in the number of employees and modest increase in the average hours of work. Otherwise, the numbers what we receive today on employment are showing that there was a revision of data. So practically what we were expecting, that the labor market probably will face to its limitations in terms of how much employment can grow and how much the firms will be forced to prolong the hours of work. It seems that the recent numbers what we received today are confirming these hypotheses. Otherwise, the growth will continue according to the forecast on the coming 2 years, but at the same time at a rate that is more or less half of what we anticipate for this year. The unemployment rate is just very much in line what I was showing for the growth of employment. The very low unemployment rate is preventing, in our view, unemployment from falling significantly further on the forecast horizon, and the general unemployment rate will therefore go down only very slowly this year, and even in the next year it will reach the level of 2.7%. So we just think that there is not too much room for much more significant fall in the general unemployment rate. The tightness of the labor market is showing up also in the wage growth forecast, and the low unemployment rate will generate an upward pressure on wage growth in market sectors, and later on you will see a slight slowdown towards the long-term equilibrium levels, and this will be aided by gradually tightening monetary conditions. Also on the forecast horizon, the inflation rate will fall from the current levels, and GDP growth will slightly slow down as well. Consistent with the forecast is the increase in domestic market interest rates in the third quarter of 2017, and later also in the following 2 years. And that was just the forecast itself, and let me just turn to the last point of my presentation, and these are the main factors that are explaining how and which are the main contributors to the change in our new forecast. And here I'm providing you a brief summary. The new inflation forecast is almost unchanged, and what we can see is a difference in the somewhat different structure in the price pressures. The domestic economy, in our view, is more inflationary, and the main factors are higher wage growth and higher economic activity. But this more pro-inflationary effect will be curbed by substantially slower growth in foreign producer prices. The forecast for growth in domestic economic activity for both this year and the next year I shifted upwards, and I will talk about the determinants why we revised our forecast of economic growth. The nominal wage growth forecast is also revised upwards, and I mentioned that we were surprised with higher wage growth in the first quarter of this year. The monthly data is indicating, mainly from industry, that the wage growth will be even accelerating in the second quarter, and of course the overall GDP growth and higher growth will also generate higher wage growth on the whole forecast horizon. The corona will appreciate slightly less than expected in the previous forecast up to the end of this year, but its path will then be similar at the longer end of the forecast, and the path of market interest rate is virtually the same as in the previous forecast. So this is just a brief summary of the main factors or main shifts in the forecast. And here now we can see that the inflation forecast, what I mentioned, is almost the same as in our previous forecast. And as I stressed, the structure of the cost pressures is the change against the last story. The domestic economy will be more inflationary over the forecast horizon, and the factors are stronger economic growth and higher wages, but this will be offset by stronger anti-inflation effect of import prices stemming from lower growth in foreign PPI. The forecast for growth of the domestic economic activity is shifted, and here you can see for both so for the whole forecast horizon, the revision is largely due to household consumption, which is practically higher than we expected last time. The reason behind the higher growth is wages and salary wages and salaries, but at the same time, investment activity will be higher, both in its private and public segment, and also government consumption will add to economic growth, especially in the second half of this year. The wage forecast moved upward significantly as a result of higher observed figures and leading indicators, as I mentioned, and it is mainly driven by tighter labor market and higher external demand. The path of market interest rates is virtually the same as in the previous forecast, and this reflects practically a similar expected path for overall inflation, the corona exchange rate, and also foreign interest rates. Ladies and gentlemen, that was the presentation, so I'm giving back the floor to Markéta Fischerová. Thank you.
Mr. Hlédik, thank you for your valuable presentation, and I think it's about time to open a discussion. We will have about 40 minutes for it. As always, I would like to ask you to state your name and the company you represent before you ask a question. Also, as we are streaming our session today, I'd like to ask you not to forget to turn a microphone in front of you on when asking a question. Okay, and now I'd like to hand over to Mr. Tomšík.
Thank you. So I'm also very pleased to welcome all of you to Czech National Bank. And it's quite, business as usual. So I will be very pleased to take like 2-3 questions for the first round. And I always prefer having like 2-3 questions, and maybe I will try to combine them together, or I will will answer some of them regarding the policy making. And if you have questions regarding the discussions, expert details, and I will pass it to Mr. Holub, who is Executive Director of the Monetary Policy Department. So who is the first one? Let me open the floor. If we do have a question, yeah, the first one, please.
Good morning, Viktor Cajzl, Komerční banka. I have one question for you, Vice Governor, and then 2 questions to the experts. Well, I asked this last time with Vice Governor Hampel, but once again, how comfortable you are with the forecast, which does not include actually all the current, let's say, developments about the corona, that it does not actually include the overboughtness of corona, this effect, and it actually may be a significant change to the forecast, especially when you are doing your exercise as a forward-looking exercise, and you have a big uncertainty, and you certainly have some opinion about what the overboughtness means, in my eyes, as I listen to the presentation, it might be that there is a significant appreciation in the forecast. While maybe even you might not have believed it will happen, and it is a significant impact into your monetary policy for its decision making. That is the first question. For the experts, we had a significant revision of the GDP and the national accounts. I know that the model does not actually include the potential, but there is an equilibrium path of the economy. So how did you deal with that? Like how much was given into the potential growth or the equilibrium growth, and how much of it actually went to the kind of output gap in the model? And one more question regarding the EU funds and investment. It seems that there is an N+3 rule in a smaller scale. In this round of EU funds, that there is a lot of funds which will have to be tapped by the end of the next year. It's still about 80 billion korunas. So do you see a risk of much higher in investment next year, especially public investment? And would it actually be a risk for weaker corona as well, as most of the investment is imported while the EU funds are transferred out of market? So thank you for this.
Thank you, Mr. Twizel. So I see that you already took your opportunity to be the first one, and you put them in 3 questions. But anyway, I remember all of them. And is there someone else who would like to, ask something in the first round? Do we have some more questions for the first round? Yeah, Helena Horska, next one.
So I was introduced already, Helena Horska from Raiffeisen. Maybe I will add to question about the exchange rate, because I would be interested in answer how you see the risk of faster and stronger appreciation of Czech koruna against the US dollar. Because as I can see, the US dollar is significantly weaker than was expected by the market. And if I look on your US dollar expectations, it's compared to current level, it's significantly stronger. So my question is, if there is significant risk of US dollar against the koruna, because it may significantly have an impact on fuel prices in the Czech Republic. Thank you.
Thank you. So that was another question regarding the FX discussions, FX, I would say, assumptions. So I will deal with that. And the last one for the first round, do we have? Yeah, please.
Hi, Mai Duan from Bank of America Merrill Lynch. I have a question regarding the board thinking with regards to the first rate hike. I remember in the previous discussion there was comments in the minutes about a first hike, if being premature, could be more damaging in an inflation targeting regime. And in the rate forecast, you have basically a first hike in Q3 and then a stable path going forward until the middle of 2018. So is that the intention of the board? And how do you reconcile that with your comments about the first hike could be premature? Thank you.
Thank you. So, well, you see that we got like 5 questions total, and that's why, I already wanted to have some of the questions, because I'm going to put some of them in one probably answer. The first one, let me start with the bank board discussions regarding the exchange rate assumptions, and if I understand your questions correctly, whether we are comfortable with not publishing all assumptions. Well, honestly, of course, if we lived in an ideal world, it would be nice to publish everything. But on the other hand, if you look around the world, there is no central bank publishing all assumptions. We did it. We did it until November 2013, as far as I remember. Yeah, we were very transparent, and at that time we just said we would suspend it. Suspend it means that when it's an appropriate time, we will resume it again. And yesterday we had discussions about that. But honestly, there are some things which, create a huge uncertainty. And our model. Our model, which is G3, has been published. You can use the model. And the model is economic model. And of course, it relies on uncommon interest rate parity. So you can calculate it by yourself. But where is the huge uncertainty regarding exchange rate assumptions? It's as follows. Because nobody knows how big is the counterpart regarding, the speculative positions of the Czech koruna. Because we clearly communicated before we abandoned the FX commitment that we see the market is overbought. And nobody knows. If you know that, I will be happy to share, your idea. But nobody knows exactly where all those, I would say, overbought situation will finish. So that's why we do have assumptions of the forecast. And yesterday, and now it brings me to the last questions, that of course I remember what was the discussions of the bank board at the last monetary policy meeting, which was 6 weeks ago. And during the last 6 weeks, there is a new situation. The new situation looks like as follows. Look, we do have a new forecast. And based on the assumptions of the forecast, we see that probably if we want to manage inflation expectations, if we want to stay with the headline inflation, especially with the core inflation, around the target, which is around 2%, well, we have to do something. Why we have to do something? Because, look, we reached zero lower bound. We reached zero interest rates in November 2012. And compare the economic environment, compare the economic situation, November 2012 and August 2017. It's completely different situation. Well, look at the rate of unemployment. Look at the rate of employment. Look what's going on in the whole world. Look what's going on in some other, sectors, in some other segments. So that's why, well, now we are sure that, we were sure yesterday that, well, we know which kind of direction we should go. There was no discussions about on hold, no discussions on, even decrease interest rates. So we were sure about that, yeah? And there is one more thing I have to add regarding the current situation. We follow this item, don't blow with the wind. So if we see that, we can, help to reach inflation target in next 12 or 18 months, so let's use the core tool for inflation targeting, use interest rates. And at the same time, I'm very pleased, personally I'm very pleased that this tool can support our macroprudential policy. I'm talking about the financial stability. That was another issue. And I'm very pleased that after a while, after several months or quarters or years, those two policies, macroprudential policies, as monetary policy, can go in line together. So it brings me back to the questions regarding assumptions. Yeah, it's assumptions, which is very easy to calculate based on current interest rate parity, based on our model. But because there is a huge uncertainty, and it's really difficult to quantify, I would be happy if you know what kind of investors, when they are going to probably go in the FX market. That's why so far we have decided not to publish it. But, well, once the uncertainty becomes lower, we are ready to resume publishing our assumptions. So that's all what I would like to say regarding the exchange rate. And Helena, you asked me regarding the exchange rate, I would say assumptions of Czech koruna and US dollar. Honestly, we mostly rely, and the key factor is the Czech currency to euro. And regarding the euro to US dollar, we take it from the consensus forecast, and we also publish it. But anyway, it's a little bit technical question, so I'm going to pass the floor to Tomáš Holub. Please, you can answer the question regarding the Czech currency and US dollar, and also there are two more questions left regarding the GDP forecast, changes, revisions, and EU funds. Please, Tomáš.
Okay, thank you. Good morning also from my side. As regards Helena's questions about the risk related to Czech koruna's exchange rate against the US dollar, for sure we now have a stronger exchange rate against US dollar than what we assume in our forecast, which, all other things being equal, is a downward risk, especially for the outlook of fuel prices. At the same time, we assume in the forecast the Brent oil price flat at around 50, while currently we are around 52. So this is to some extent offsetting the downside risks for fuel prices, at least in the near term. So I don't think it's a big risk for the moment overall, but we'll see how this develops. Maybe one more remark on Victor's question about the overboughtness of the market. Just to clarify, we do take into account the overboughtness phenomenon for the near-term forecast, the current quarter. We can observe what's going on in the market. It's for sure affected by the overboughtness, which acts as a kind of inbuilt stabilizer. And we have reflected the current exchange rate levels in the near-term forecast. We just want to be on the safe side for the coming quarters. We don't want to count on the overboughtness continuing to function also in the longer term future, because we are not certain about this. We acknowledge that due to this factor, the risks to the forecast as regards the exchange rate path are skewed to the upside the bank board yesterday acknowledged that this is the main upside risk for the forecast, and that's why they assessed the overall balance of risk as slightly pro-inflationary. This also partly answers May's questions about the risk of premature hike. Given that we tend to be on the safe side regarding the exchange rate outlook and the baseline forecast, we may be less worried about the risk of tightening too much, because there is actually a chance that if the overboughtness of the market prevents the exchange rate to appreciate in line with the forecast, there may actually be scope for more interest rate increases. But of course, we are cautious in the forecast as such. So following the forecast is not associated with too much risk of being ahead of the curve. As regards Victor's technical questions about the significant revision of past GDP figures and the impact on potential versus the output gap estimate, of course you'll see the estimates next Friday when we release the full inflation report. But speaking about the estimate from a small structural model, we basically come to the conclusion that we are slightly above potential. The output gap is slightly positive at around plus 1%, basically from the beginning or from the middle of 2015. And it was to some extent affected also by the positive upward revision of the GDP figures in 2015. But as a general rule, those revisions tend to be passed more than 50% into the potential growth estimate, because the small structural model, it doesn't look just at the GDP figures, but it cross-checks the GDP numbers with the observed inflation developments, which do not change, and also with the observed developments of monetary variables, interest rates, exchange rate, etc. So this gives some robustness of the estimate of the output gap with revisions of GDP figures. But for sure, the model always splits it partly into the output gap, partly into the potential, but the tendency is to put more of it into the potential. I don't know if Tibor wants to add more on this.
This is exactly right. We just identified that the output gap is just positive, and I think this is something what we wanted, because this is the way how bring inflation back to target. So I think that this is exactly in line with how I described the economy. So there are inflationary pressures. So this is one thing, and maybe one more reaction to the question regarding the US dollar. I think that in terms of the forecast, there are much more uncertainties in terms of commodity prices, both in terms of energy, but also food prices, which is driving our food price inflation forecast. So compared with the volatility of the US dollar, I think there are more risks there.
And last questions related to the EU funds. We do indeed take into account that public investment is recovering already this year, and it will increase further also in 2018. For sure, the investment is import intensive, so it's also reflected in our forecast of net exports. We actually expect that while this year net exports will have a positive contribution to the GDP growth, they will have similarly negative contribution next year. So imports in real terms will increase faster than exports, and the main part behind this is recovery in domestic demand, especially in domestic investment. And the investment cycle is to a large extent driven by the EU money. And to the extent that in our model the exchange rate forecast is to some extent linked to the developments of net foreign assets, which is affected by net exports, we do take this into account in the exchange rate trajectory. But so as such, it would speak in favor of slower appreciation, but in the forecast it's outweighed by the three factors which push us towards stronger currency, which is the long run appreciation trend, the positive interest rate differential against the euro area, and the ongoing QE by the European Central Bank. But on the margin, this factor is at least partially taken into account, but it's not strong enough to outweigh the other factors.
Let me elaborate a bit, with the issue about the premature hike. I think I've already said that, once the bank board, compare the situation, right now in August 2017 with the situation November 2012, I said that, it's completely different situation. And we just delivered the first step, the first hike, and Mr. Holub, he has just mentioned that we are, aware that once we increase interest rates, that we will increase the positive interest rate differential. He mentioned that, we presented it. And this is one of the, I would say, element what we expect regarding the further appreciation of the Czech currency. So we are very transparent. We are saying that, we embedded in our forecast that the FX, the Czech currency should appreciate based on three factors. It was mentioned, the first one, positive interest rate, the second one, quantitative easing of ECB, and the final one, which we are very, very transparent, we calculate with the still renewed real convergence. And why I'm saying that, of course, if you put together that, those two monetary conditions based on real interest rates and based on real exchange rate, of course, we have to put them together and say, well, what is the final monetary policy index? What is the final monetary policy conditions? So we just started with the first one because we are, I would say, quite sure regarding that the core inflation is about 2%, and the forecast, which has been already calculated with the increase of interest rates, the forecast of core inflation will stay around 2%, which is completely different situation comparing with the year of 2012. In 2012, the core inflation, was in negative territory for 5 years. Well, it's completely different situation regarding the labor market, regarding the wage growth, regarding the fiscal situation. Well, 5 years ago, there was a restriction in fiscal policy, and finally we see, robust GDP growth. So again, well, we delivered the first, part of the monetary policy condition index, and we will see what's going on with the second one. That's why, so far, we still keep, the FX assumptions unpublished, but we will be ready to resume it. Yeah, let me continue with the second round of the questions, if we do have some others who has Mr. Sobíšek.
Pavel Sobíšek, Unicredit Bank. I have another question related to FX, and that is related to the role of the finance minister or finance ministry. There's a perception in the market that the finance ministry may end its issuance policy or issuance practice may be an important factor on the FX market. So my question is whether there's any coordination in the issuance of bonds and T-bills between the finance ministry and the central bank. Thank you.
Thank you for the questions. The second one in the second round.
Jaromír Šendel, Citi. I would like to ask you about the spread between the deposit rate and two-week repo, which was, let's say, deposit rate was unchanged. So how long you will keep the deposit rate at almost zero? And the second question is regarding difference between two-week repo and 3 months PRIBOR, because it seems to me that 3 months PRIBOR doesn't react or didn't react too much, or even forwards. didn't react too much to your hike. So what does it mean, let's say, for your 2-week repo outlook?
Thank you. And the last questions in the second row, if there is any. Yeah, your colleague, please.
I just want to follow up on the answer you gave on the first rate hike. I mean, the meaning of my question is that why would you deliver a hike and then a pause? Why not wait until you can see there's a path? And I think it relates also to your comments about the housing market and macroprudential and monetary policy working in the same direction, in the sense that if you want to really impact mortgage pricing, you basically have to signal. But because it seems that the way the board is thinking is not in the same kind of situation. So why the start and the pause? That's more of the implication, I think. Thank you.
Thank you. So probably I will try to address some of the questions, and Tomáš will handle with some more technical details regarding the spreads. Yeah. Let me start with the first questions, whether there is, I would say, any or some coordination between CNB and the Ministry of Finance. Well, of course, because those two authorities, they cooperate and they always sit together, and they discuss what kind of monetary policy we are practicing now, what kind of fiscal policy we can expect. But we respect the autonomy, of course, yeah. So there is always a discussions, among experts, yeah. But we fully respect their decisions. And if you have questions regarding the issuing bonds, regarding the term structure, well, I think it's questions to the Ministry of Finance experts, yeah. But I have to say that the cooperation between both authorities, has been doing very well in a general way. The second question is regarding the spreads between two-week repo rate and Lombard rate and depository rate. Well, I remember, and back, to the transition period, like 10, 15 years ago, I remember the spread was about 100 basis points. But at that time, the level of interest rates were completely different. And yesterday, we had zero interest rates, so just 0.05, yeah. And well, if you want to start normalizing interest rates, that's a question whether you should really, try to have the same spread as you used to have several years ago. So at least once you look at our decision and our yesterday's decisions, at least we started, I would say, going to, distinguish between deposit rate, two-week repo rate, and we will have to wait. I really can't answer whether finally we will end up with 100 basis points, difference. Well, it's really premature to answer these questions. We have to wait for the future. We have to wait for the future macroeconomic conditions. And the final question was about, again, the yesterday's rate hike. Of course, once you rely on quarterly data, once you rely on your forecast, which is prepared and published quarterly, it's always difficult to really see the difference once you deliver any monetary policy actions now or after 2 weeks, 3 weeks, or 6 weeks, Honestly, it's very difficult. Even if you run, we call it a sensitive scenario or some alternatives, it's very difficult. But we did it. Our monetary policy department really was doing very good job during the summer holidays, and they prepared a lot of sensitive scenarios. And those sensitive scenarios clearly showed that, well, probably there is no significant delay. There wouldn't be significant if we, probably, increased hike. If we delivered a hike, in September. But on the other hand, and this is the philosophy of inflation targeting, if you see that it's, time to do that, if you want to manage inflation expectations, do it, yeah? And as I said it, at the beginning that, of course, this is the monetary policy. But the Czech National Bank is now also responsible for financial stability. And we do have macroprudential policy. We use our, tools for macroprudential policies. But if we do have a chance to put, those policies together, and right now it seems to us that it's a really, period when we can do that, because probably it's a time to start delivering, the tightened monetary policy. And regarding the financial stability, we have been quite open to, say to all general public that, there is no doubt it's time to deliver more tightened macroprudential policy. We have introduced countercyclical buffers. We have introduced some recommendations regarding the housing markets. So again, it's time, don't blow with the wind. So we took the opportunity and we said, okay, let's use this chance, and use this, tool, which is primary for monetary policy, but right now it's also very handled tools for macroprudential policy. So I'm here to represent Bank Board. So honestly, there was a discussions about that. It will be in the minutes, and why not to use that? Tomáš, do you want to add something regarding the spreads and probably the difference between 3 months PRIBOR and 2-week repo rate? Thank you.
Well, technically speaking, in the forecast we assumed an unchanged spread between 3 months PRIBOR and 2-week repo, which means that we assume that the 3 months PRIBOR will follow the hike in repo rate. I don't think it's worth commenting on the development so far. We did the hike just yesterday. We'll need to watch whether the market interest rates really go up in line with the policy rate. And short-term deviations definitely don't play a role from the monetary policy perspective. But we'll definitely watch whether the transmission into the market rates works in the usual way going forward. So I think that's it. Yeah.
I see it's like 3 minutes to 12 to midnight. So anyway, I think we still have some time for at least one more round of the questions. Yeah, please. The last round? Or so far everything was clear? I would be happy if everything was clear. I see that. Yeah, please, Mr. Cisa again.
Viktor Zeisler again. So I would like to rephrase my first question. It meant to be like how comfortable you are with the fact that the FX forecast does not include actually the overboughtness in the model, as it is one of the most important assumptions in my eyes for the developments, and well, as the FX actually is the crucial variable you watch now. So, and well, you don't have actually the very honest forecast of it, including all the market situation in your model now. So how comfortable you are with that?
Was the first questions? If we don't have any more, so it's going to be the last one. All right, so let's conclude. Okay, I think I understand your questions, but look, honestly, I think that all economists would be very happy to know everything in details and in perfect way. But the reality looks a little bit different. We live in a real world, and real world has a huge, has a lot of pieces of uncertainty. This is the reality. And I think that Tomáš Holub, he has already said that, we are quite sure, we see what's going on in FX market, right now. So we know at least how to deal with the uncertainty for the first quarter of our forecast. That's why the first quarter of our forecast, includes that there is some, I would say, pressure or situation in the FX market regarding that the Czech koruna is still overbought. It's obvious. But, there is uncertainty regarding the second quarter, the third quarter, etc. But the same holds not only with the FX market. Honestly, the same holds with the all other economic variables. I do have a huge uncertainty regarding the future development, for example, in Eurozone, the future development in US market, etc. And that's why we prepare and run our forecast every quarter. And I remember that we take the decisions based on the current economic situations, on the current economic information. And that's why, and it was clearly presented by our governor yesterday, well, based on the current assumptions, based on the current economic situation, well, the whole bank board decided to deliver the hike. But there is almost nothing to say for the future because, there is uncertainty and we have to wait, for the market development for next 6 weeks, 3 months, etc. But at that time, we will have, the evaluation of the new, I would say, information. We will have the evaluation of, how the uncertainty is going to materialize. We will have new, forecast the next 3 months. So based on the current economic situation, we deliver, well, the forecast, and we clearly presented that if there is no surprise, you can expect some, changes in interest rates in next 2 years, yeah. But, as I said, definitely it's not a commitment, it's just an assumption, and we have to wait what's going on regarding some other economic variables. Of course, FX is one of the key variable, one of the key uncertainty. But at least you see that we are very transparent, we really talk about it. And we say what kind of uncertainty we see. This is all what we can do now, because as I said, so far I haven't seen any really 100% reliable, something as a commitment that anyone from the market knows exactly where, we can say speculative investors or some other investors are going to change their FX positions, because nobody knows that. So I just can deliver the promise that we will react on that, and we will, that's why I would say the future is ahead of us. Tomáš, you want to add something?
No, I think, of course, ideally, you would, at least in normal times, like to have a forecast with completely balanced risks on both sides, but we are still not back in the normal world. We still need to apply kind of risk management approach and to be on the cautious side. After all, we are the first central bank in the EU to start the hiking cycle, and I understand that you suggest that if we incorporated the overboughtness of the market into the forecast, we could have produced an even more hawkish forecast. But as Vice Governor Tomšík says, if the exchange rate tends to appreciate less than we have in the forecast in the future, we can always react to it. The reaction function is clear, and I think it's important.
Before we conclude, Tomáš clearly said that, well, we are the first central bank in the European Union which has increased interest rates. But I think we should also say that I think that we were the first one, or at least among the first one of the central banks which cut interest rates in 2008. Yeah, so it's logical that, and again, we rely on our forecast and we are quite transparent and we communicate with the market, with the general public, what kind of uncertainty we really see. But this is all what we can do right now. There is nothing else. Thank you. So I'm very pleased that you have come for discussions. And now let me hand over the floor to our spokesperson. Yeah. And she's going to conclude and invite you for the next meeting, probably. Yeah.
Because the last question was answered, let me conclude this meeting. I would like to thank to our speakers for their contributions and also to all of you for coming and participating in the discussion. I'm looking forward to meeting you at the next analyst meeting, which is scheduled for the 3rd of November. Thanks again and goodbye.